So welcome today. We're going to talk about Real Estate 101 today. How does a seller sell a home? How does a buyer buy a home? How do the agents that work inside the transaction get paid? Who pays those fees? What are the amounts of those fees? And then who represents who? So let's go through some real quick basics on Real Estate 101. And then I'll introduce very quickly conventional FHA and VA financing, which are the most common ways that people buy homes unless they pay cash for them. Okay, so let's just do a real quick little graphical representation here. Let's look at our computer screen today and say that that this person calls our real estate company today and wants to sell his home, her home. Let's say her today wants to sell her property, so she calls our real estate company. Hi, my name is Cindy, and I would like to sell my home. Can you tell me what you guys charge to sell a home? Okay, now you might get that question pretty quickly when you're working inside a real estate office. So let's look at the screen. Here's what we've got. We've got a listing. Okay, so it's a home. Somebody wants to go sell it. We're going to go put our sign in front of it if they hire us to do the job. Okay, so what's our benefit? Well, we have our guaranteed sale program. Hey, great. We're glad you called today. You probably heard Wally and Cindy have this guaranteed home sale program. In the unlikely event that your home doesn't sell in an agreed period, Wally and Cindy can step in and agree to buy your home for cash at a price we agree to up front. This is something that our company does that others don't do. So we'd love to visit with you about your property and selling your home. We would love to be your listing agent, or what we call the seller's agent. Okay, we would love to, and we don't ever just want to say we want to go list it. We would love to help you sell your home fast and for top dollar with the least hassle and inconvenience for you. Okay, so that's when someone calls and wants to talk to us about listing their home for sale. Now, one of my best inside sales agents used to say this, and you should probably practice this and internalize this. Wally and Cindy sell hundreds of homes every year. They spend a ridiculous amount of money advertising and promoting your property. We would love to have the opportunity to sit down with you and review what will be done. We'll be able to visit with you and tell you three things within, a day or two. How much your home should sell for, how long it should take to sell, and how much you'll walk away with when all is said and done. Would that be helpful? So we start off getting a yes answer. So we meet with Cindy at her home. Okay, that's the seller in this case, named Cindy. We go over and meet with Cindy, and she's very pleased. She likes what we do. She likes our guaranteed home sale program, and she likes the idea that we advertise a lot and sell hundreds of homes each year and have a big team. That's a huge benefit also, is to talk about the real estate team instead of being a single agent who is juggling all the balls at one time, trying to take care of everything. Their listings, their showings, their closings, their computer work, their advertising, their budgeting, trying to stay caught up with all that is juggling a lot of balls. That's a big, great advantage to working with Kerr Team Real Estate. Okay. So in this case, if Cindy hired us, let's change her name to Susie so it's less confusing. Wally and Cindy own the company. Let's call this seller Susie. Susie agrees to pay a brokerage fee. Okay. Susie's going to pay a percentage of what her home sells for. Let's say it's a $100,000 home, and she agrees to pay a 6.5% fee. Okay, in that case, she's going to pay $6,500 to have her home sold and professionally managed by our firm. Now, we're going to take that home and we're going to put it on the multiple listing service in most cases, and we're going to invite other agents to show that home and perhaps earn part of the commission if they bring a buyer for the property. So I'm going to scroll on down here, and that is a buyer's agent. Okay, so in most real estate transactions, not all, there are two realtors involved. There's a listing agent and a buyer's agent. Okay, seller's agent, buyer's agent. You can think of it that way. Now, when you think about it, we might list a home and we might sell that home ourselves. Kerr Team Real Estate, one of our agents, or even the listing agent, might get a phone call. Ring, ring. Hi, I'm calling about 123 ABC Street today. We give them the information. We give them the price. Yeah, I'd like to see that property. When could I see it? Well, great. We'd be glad to show it to you. How does 4 o'clock work? Yeah, that sounds great. So now we dispatch the listing agent. Let's say that is Paul on our team. He's the listing agent, but he also gets the opportunity to sell it himself because it's his listing. So we refer that buyer to Paul. Hey, Paul, Brian called and would like to see the home at 123 ABC Street today at 4 o'clock. He's pre-approved. He's a good buyer. He's not working with an agent. He's planning to buy now. Okay, so Paul goes over and shows Brian the home, and Brian writes an offer on it. And he and the seller, Susie, come to terms between each other. Now Paul is both the listing and the selling agent on the property. Okay, he is representing the seller and he's representing the buyer. Okay, that happens in a lot of cases. So there's no commission to be split. Our firm is going to earn that entire, let's say it's $6,500, and then the agent, of course, gets a split from the company. All right, but in a lot of cases, it's going to be what we call a cooperating agent. Okay, that's something you should remember. A cooperating agent is one that's cooperating in the sale. So they are working with the seller's agent, okay? And that cooperating agent is representing the buyer, and they write an offer and negotiate back and forth. And when we go to closing, which is typically 35 to 45 days down the road, okay, each of those agents gets compensated by the seller. Doesn't cost the buyer a penny inside the transaction in actuality, okay? Is the buyer maybe paying a price that includes, the representation by both agents? Yeah, sure. That's just part of the transaction, but it is typical, normal and typical for the seller to pay all of the real estate brokerage fees involved. So what does the buyer have to pay? Well, if they've got enough cash in their bank account, they can go buy it cash, right? But a lot of people don't have that much cash. Here, let me get off and I'll come back on the camera. Okay, so what happens is a buyer goes to a bank or a mortgage company and wants to borrow money. Okay, they're going to have some down payment, right? Doesn't that make sense? The mortgage company would like to have a down payment. In most cases, veterans, if they have served in the U.S. military, active duty or reserve, okay, they can go get a VA loan from the Veterans Administration. Now, they don't go straight to the VA. They just go to a mortgage company, and the mortgage company in many cases will offer FHA and VA loans. FHA is the Federal Housing Authority. VA is the Veterans Administration. Okay. Why do veterans get in with no down payment? Well, they served our country. Okay, they served our country and gave up and had military time, spent time away from their families. And so the U.S. government rewards the veteran with a zero down payment loan. Okay, that's the lowest down payment in the industry. Now, for first-time home buyers, there's also this thing called bond money. Okay, bond money is where the Oklahoma Housing Finance Agency, let's just call it OHFA. You don't really have to remember that. Just remember that bond money is available. Bond money will pay up to 3.5% of a buyer's down payment for them. Their interest rate's a little bit higher, but it helps buyers get in that qualify. There is an income limitation, and they cannot have owned a home previously, or I believe it's over the last 3 years. So that's a bond money loan. Don't try to explain too much. That's the lender's responsibility to do this, okay? Then there's an FHA loan, the Federal Housing Authority. This is basically our government stepping in and saying, we want to make loans available for people that don't have a whole lot of money for down payment as long as they follow guidelines. Okay, so an FHA loan requires a 3.5% down payment. On a $100,000 home, that's pretty easy, isn't it? That's $3,500, okay? Then there are closing costs. What are those? Well, that's like ordering a property appraisal. The mortgage company's not going to go in and loan money unless they make sure that the value of the home doesn't exceed what market values are. So there's appraisal work, there is title work, there's title insurance, there are closing company fees, there are origination fees. Don't try to remember all that. You don't need to explain that, but you can remember a percentage here. Okay, closing costs are generally about 2.5% of the purchase price. About. So on a $100,000 home, closing costs probably around $2,500 generally. Okay. On a $200,000 home, 2.5% is $5,000. So you go buy a $200,000 home, you need down payment money, and you need the closing cost money. Now, it is legal for the seller to pay the closing costs as part of the contract. So if a buyer said, well, yeah, I've got my down payment money saved up, I might typically be talking to a buyer. Hey, how much have you guys saved up to put down on your first home? Well, Wally, we've got $5,000 in pocket. Okay, great. Well, if you're going to buy a $150,000 home and you need a 3.5% down payment, and you're going to go on an FHA loan, which is the lowest down payment available, that's $5,250. And you don't have to have that $5,000 today. You just need that money by the time we close, which is 35 to 45 days down the road. So really the only money you're going to need right now is when you write an offer on a home, you're going to make what's called an earnest money deposit. You're going to write a check that says, hey, Mr. Seller, I am earnest, I'm sincere about buying a home, and I'm going to put this money down. And if I just wrongfully back out of the contract, if I just decide I don't want it, feel like it's too big a financial obligation, then I'm going to put down earnest money that says if I back out wrongfully and I don't follow the contract terms, I'm going to lose the earnest money. So what the buyer needs is they need some earnest money when they make an offer, typically about 1% of the purchase price. Okay, so if it's a $150,000 home, it's about $1,500 in earnest money. And then they're going to have to pay for an appraisal of the home. That's typically around $500. They'll have a very specific credit report prepared by for the mortgage company. That's about $50. Okay. And then they're going to pay for their property inspections, probably around $400. So add that up real quick. On a $150,000 purchase, what did that add up to? $1,500 earnest money. Okay, $500 for the appraisal, that's $2,000. $50 for the credit report, which is $2,050, and then add about another $400 for the appraisal. So the buyer really needs, within the first 10 days of the transaction, needs about $2,450. Now, if the total down payment was going to be $5,250, where did I get that number? Okay, remember that was a $150,000 purchase times a 3.5% down payment is $5,250. Okay, that's all the buyer absolutely has to pay. Okay, so that $2,450 we just figured for earnest money, appraisal, credit report, and the inspections, that's going to be credited back to the buyer. So the remainder of the money they need for closing, to complete the transaction, they just have to have by closing. Don't try to explain too much and don't get the buyer confused. I just want you to understand the process. Earnest money, appraisal and credit report, okay, and then property inspections. Buyer's going to need some money, but they could also get down payment assistance through the bond money program, and that would help them cover those costs. Then there are the closing costs, and again, that's about another 2.5%. The seller can pay those for the buyer. Now, it's not typical in the current hot marketplace for a seller to pay the buyer's closing costs, but there are ways to get that done. Sometimes the buyer can pay a slightly higher interest rate, and the mortgage company will pay the closing costs for the buyer. So the buyer's just paying a little bit higher monthly payment per month, but in exchange, that keeps them from having to come up with the money up front. Okay? So that's FHA and VA loans. And then there is conventional loans. And conventional mortgage is a little bit different. It's not guaranteed or underwritten by the U.S. government. It's really just going to a bank or a mortgage company. Most conventional buyers put down somewhere between 5 and 20% down payment. So when someone says to you, hey, I'm going to put $100,000 down, if they're talking about a $200,000, $300,000, $400,000, $500,000 home and they say $100,000 down, your first thought is, well, they'll probably do a conventional loan because that's going to make more sense for them. Easiest way to think about it is people putting a minimum amount of money down are typically either buying on a VA loan, okay, with no down payment, or they're doing an FHA loan with 3.5% down. That's just minimum down payments. Most people who have a lot of cash in the bank or are buying their second or third or fourth or fifth home, whatever, they end up having what's called equity in their home. Let's explain that. What's equity? Well, let's say that their home today is worth $300,000 and they only owe $220,000 on the home. They have $80,000 equity in their property, right? Okay. So they've got a nice big down payment. Normally buyers like that will do a conventional loan. That's a very quick explanation of conventional, FHA, and VA financing, and letting you know that bond money is available. There are some alternatives for zero down payment, but people do have to have good credit scores. Let's end with talking about credit scores. In most cases, at least a 620. Most mortgage companies like it to be 640 or higher, but there are some places like Weoki Credit Union, which will look at a 620 credit score. But it's not just credit score. It has to do with what's called their DTI, their debt to income ratio. How do you compare their income with their debts? Well, if they're making $4,000 a month, you'd think they could buy a home, right? What happens if they have $2,000 a month in debt? Really only leaves them $2,000 a month to qualify on, and you're not probably going to qualify for much on $2,000 a month. So it's called the debt to income ratio. Last thing we're going to talk about, and then we're done, is length of work or length of tenure of work. Pardon me. How long you've been on your job. Let's keep it simple. Okay. So somebody who is working for an employer, somebody who works for Walmart, somebody who works for a company, a corporation, they're employed. Okay. They get W-2 wages. They need to be in the same line of work, or the line of work needs to be closely related if they have not been on the same job or in the same profession for at least 2 years. So if you worked in HR with one company and then you went and worked in administration with another company or as an accountant, okay, that would be relatable. And that person needs to be in the same industry without a whole lot of gap of employment if they change jobs for at least 2 years in the same industry. Or if they have come out of college and they immediately start with a job, all they have to do is show their college transcript to show that they were in college and then show that they got a job, and they will be able to qualify okay, right out of college, okay? Now, for somebody who owns their own company or is self-employed, it's a totally different animal. They're going to need 3 years typically, and this is really in almost all cases. They will need 3 years of filed tax returns. So it can't be 2 years and, hey, I'm in my third year. They're going to have 3 years of filed tax returns. Let's say that I own a business. The first year I owned my business, after all expenses, I had $100,000 profit. In the second year, I had $150,000 in profit. And year 3, I had $200,000 in profit. The average is $150,000. That's what the mortgage company is going to look at, is they're going to average the 3 years and use that average as qualifying income. Then they're going to take off my debts, look at my debt to income ratio, and determine if I qualify. Okay? That's the easiest way. That's real estate 101. Okay. Down payments, closing costs, the types of loans available, and then how we work for people. Look at your screen again. Okay. If I go list a home today and I'm working for the seller and they've listed their home in Kerr Team Real Estate, or Your Home Sold Guaranteed Realty is representing the seller. Okay. We're a seller's agent. We have a listing on that property, and our obligation and duty is to get that seller's home sold as quickly as possible at the highest possible price with the least inconvenience to them. Let's turn it around. One of my friends today calls up and they want to go buy a home. Now I'm a buyer's agent. I go put them in the car, get them pre-approved, show them homes, write a contract, go through all the process, and I show up at closing and I get compensated by the seller in almost all cases, and I receive a part of the brokerage fee, but it is indeed typically the seller, okay, who is paying that brokerage fee, and I receive my cut inside the transaction from whatever the seller's agent negotiated for me to be paid. Okay? Don't try to explain all of this. Just remember that buyers typically don't pay anything when they buy a home, and for the seller, they pay real estate fees. How do I explain it to buyers? Hey, it's fun being a buyer. You actually don't have to write a check for our services. They're already included in the purchase price of your transaction. Okay? You don't pay us anything, and sellers pay our fee. That's Real Estate 101 for today. Thanks for watching. Appreciate it very much.